Okay, so with that, let me turn it over to our guest speaker. I've known Ed Renninger for about 10 years. Many of MEA's members are ESOPs, and Ed is one of the leading experts in this space. He is the president and CEO of SES ESOP Strategies, and I've asked him to come talk about this. I think this is timely, as many companies are getting a lot of acquisition offers at very kind of interesting multiples, and this is another alternative for companies to consider. So Ed, thank you for joining us.
Absolutely. Thanks, Kevin, for letting me be here. Let me share my screen here. We'll get this going. So I'm going to try to keep this fairly high level here to, kind of really keep it at the basics. This is not intended at the end of the day to be a really deep dive into what an ESOP is or how it works. And the audience I'm kind of targeting here, if you will, is really an audience that might be considering some sort of an M&A transaction or some sort of a liquidity event. The theory being that an ESOP is really an alternative to another type of liquidity event or a sale type of a transaction. So with that as background, what I like to do actually is spend some time on this screen here, the ownership transfer options screen. And what I find is that this is a way to help business owners think about and clarify their own goals and objectives when they're thinking about potentially selling their company. What you'll see across the top here are various different mechanisms or ways, side or left-hand side of my screen, I don't know how you're seeing it, from a gift or estate transfer to what's called an initial public offering or an IPO at the right side. Now, our clients generally are not big enough to even consider IPO, so it's really not a viable alternative. Most of our clients tend to be what we would classify as middle market companies that are privately held. Middle market meaning fairly small relative to the really big companies that we all know and love, and on the publicly traded companies out there. And what this is trying to show are there are a lot of different mechanisms that an owner can use when they're thinking about transitioning their business. So what we'd like to do is we like to go through those with an owner. We like to have a consultative conversation with them where we're exploring what these different options mean. And what we find a lot of times is that a lot of advisors are focused solely or almost exclusively on what we like to call cash consideration. And in fact, many advisors will use the term value when talking about the cash consideration, meaning the actual money you're going to get from the sale. And I don't want to minimize that. It is by far and away the most important thing to most of our clients. But what we've found when we talk to our clients is that it is not the only thing that clients consider. And in fact, in many cases, what we've discovered is that once you can get the number, whatever your number happens to be, and everyone has a different number, right? You have your own goals with respect to your life. You have your own charitable giving goals. You have your own family or children or grandchildren that you want to take care of. You have your own lifestyle that you want to live. And once you're able to satisfy that, we have found is that it opens up a whole new world of opportunity in exploring other potential ways of transitioning the business. And so that lets us look at other, excuse me, I forwarded a slide there and didn't mean to. Lets us look at other value drivers, other mechanisms or things that can be important to an owner that might accomplish those goals. So what we'll hear a lot of times in these conversations with our clients are, well, you know what? I do need to get money out of my business, but I want to make sure that the business stays in the community. In other words, it's been part of this community for a long time, and I want to make sure that it can continue to grow and benefit the community. I want to give back to those employees who helped build my business. I want to maintain the legacy that has been built up by the business. I want the name to be on the side of the building in 5 or 10 years from now, even if I don't own it anymore. So when we hear owners who start bringing up those types of things, immediately a light bulb goes off for us and we start thinking, you know what? An ESOP may be a really good transition tool for you, because as you can see here, an ESOP is green on those items. It is good at rewarding employees. It's good at maintaining legacy. It's good at minimizing cultural disruption. Whereas selling to a third party is not as good on those things, because a third party is going to run the business the way they want to run the business. And so if we can get enough cash from an ESOP transaction and still satisfy these other goals or value drivers that the owner has, an ESOP then could be a very viable alternative. We hear this a lot of times, right? For someone who has a family business and they want it to go to the next generation, for them, the cash they get out from that transition may not matter at all. They may care a lot more about maintaining family control, for example, than getting a lot of cash. So those are the conversations we'd like to have with our clients and try to balance, if you will, the need and desire to get liquidity out of the business with whatever other value drivers they may have. And we're agnostic on the value drivers. Every owner has different things that are important to him or her. And our goal is to try to figure out what those are. So at the end of the day, we can come up with a strategy that's most likely to accomplish our goals and objectives. So the key takeaway, I think, from this slide is an ESOP is really good at doing certain things. It's getting fair value, and I'll talk about fair value a little later and what that means. And it's very good at, in doing that, also rewarding your employees, your management team, minimizing your cultural disruption, maintaining legacy and community. So those are the things an ESOP tends to be good about. And those tend to be the reasons why business owners look to us and have conversations with us about potentially doing an ESOP transaction. I should have thrown out there, by the way, when I was getting this started, that please, if you have any questions, feel free to ask those questions as we go through this. I don't feel the need to save them till the end. I'm going to try to monitor the Q's and A's as we go through this so that everyone, I can answer those as we go through. Okay, so I'm going to go ahead and move on here. Again, keeping in mind that I'm trying to keep this fairly high level. So what is an ESOP? An ESOP is a type of a retirement plan called an employee stock ownership plan. But as a type of a retirement plan, what Congress has put in place and what they're trying to do is they're trying to incentivize business owners to sell their business to an ESOP. And so they created a lot of tax benefits. And I'll go through some of those tax benefits a little later on. But I think that one of the key other things to keep in mind is, even though it's a retirement plan, Congress said when they put this in place, they said, we want this retirement plan, this ESOP, to invest exclusively or primarily, is the language they use in the Internal Revenue Code, primarily in employer securities. So unlike a 401k plan that is intentionally diversified, right? You're trying to diversify it to minimize the downside risk of an asset losing value. In an ESOP, it's the opposite. In fact, you're not supposed to diversify. Instead, by law, you're supposed to invest primarily in employer securities. So Congress created the structure to put ESOPs in place to ultimately benefit the employees by indirectly owning the company, if you will, through this ESOP. So that's the structure that Congress utilized with the tax code to try to encourage owners to do this. The big difference, as I mentioned, is because it's invested primarily in employer securities, rather than kind of tracking the stock market as a whole, like a 401k plan may do over time. The benefit is when someone retires with an ESOP account, because their account is invested primarily in employer securities, they get then paid on retirement the value of whatever that stock is worth in the future. And with these tax benefits that Congress has put in place with ESOPs, what we have seen is that ESOP companies outperform market returns by orders of magnitude. And in fact, and I won't go to this slide because it's way later in the deck, but when you look at the value of retirement accounts for employees at ESOP companies compared to non-ESOP companies, and this is a mind-boggling statistic, the employees at ESOP companies have 2.5 times the retirement wealth of their peers at non-ESOP companies. That's an unbelievable number. We have many, many clients where employees will work there for 10, 15, 20 years, and they'll retire with $1 million ESOP account without putting any cash in on their own. So it's a really, really large employee benefit at the end of the day. So moving on to a couple other slides here. There was one question that came up. Someone was asking, is it possible to sell an ESOP company? The answer to that is yes. We actually had 3 or 4 clients last year that were ESOP companies that ended up selling to third parties. So ESOP transactions of sales of ESOP companies to third parties happen all of the time. The liquidity that's generated in that transaction obviously goes to the ESOP if the ESOP's the sole shareholder, rather than going to the former owners, because the former owners got their liquidity when they sold to the ESOP. So it's something that can happen. And we do deal with it. We do form more ESOPs every year than we sell ESOPs to third parties. Our goal is to create what we call sustainable ESOPs, so that if the company and the employees choose to, they can stay an ESOP company in the long run. Okay, so moving on here. This just tells you that we're doing a lot of ESOP transactions right now. Part of it is this wave of baby boomers coming in to kind of the age of where you start to sell businesses. It's leading to really a lot of M&A activity in the market. We were busier last year on just straight up M&A sales than we've ever been. And we also formed more new ESOP companies than we've ever formed in the history of the firm. So this is something that is very active, very dynamic right now. And it looks like, based upon the calls we have coming in now and the meetings we're having with our prospects, that this trend is going to continue. So it's something that's very, very active right now. I'm going to go through these next couple slides very quickly here. The key takeaway I want you to get from this slide is that when someone sells to an ESOP, the goal is to get what we call fair value. Fair market value is actually the defined term that Congress uses. And what that is it's a price that's determined by an independent appraiser, but it's supposed to be what a willing buyer would pay and a willing seller would sell for, with neither of them being under a compulsion to buy or sell. So the goal is to arrive at really what is a fair market value for the business. And what we have found is we're pretty good at doing that. What we don't get in an ESOP transaction, of course, is the ability for 3 or 4 buyers to bid against each other and drive the price up to something that is kind of beyond what you may consider to be fair market value. But at the end of the day, we regularly do our transactions for what we call fair market value. And that is a very common thing, and we take a lot of pride in that. So a lot of people might have this misperception that they're giving the business away or they're selling for less than fair value, but that's just not the case. Another question that came in is, are employees allowed to buy into the ESOP? It's possible. Sometimes we will structure an ESOP transaction where employees can take, say, 401k and use that as seed money to buy into the ESOP. It has to be retirement assets in order to do it, because it is a retirement plan. But that said, most of our clients choose not to do that. Most of our clients choose to make it purely an employer contributory benefit rather than something where the employees buy. Another question is, well, what happens if a company doesn't do well and eventually claims bankruptcy? In those scenarios, which, by the way, do happen once in a great while, but are exceptionally rare for ESOP companies. But when they do happen, then what happens is the employees lose the benefit, the ESOP benefit that they had, because the stock is not worth anything anymore. They don't lose their 401k plan. And most of our clients, this is an additive benefit, supplemental, not something that is taken away from the 401k plan. So they still have those assets safe and secure. They just don't have any assets coming from the ESOP. Again, exceptionally rare. When you look at the returns, again, keep in mind that statistic I talked about earlier, 2.5 times the retirement wealth. That even considers those companies that don't perform well. So moving on here, I'm going to fly through some of these. Employees don't have the right to look at all the company's books. The employees don't control the company. You still have a management team. You still have a board of directors that runs it. ESOPs are no more expensive to put in place than any other type of an ESOP transaction. Good question here that came in is, where does the seller's payment actually come from? And I'm going to touch on that in a couple slides. I'm glad you asked, because it's really leading to that in just a couple slides here. So there's 2 broad categories of ESOPs that we work with. One is what we call a non-leveraged ESOP, which is there is no debt. We're not borrowing any money to finance the transaction. The ESOP's not borrowing any money. We're just contributing either cash or stock every year to the ESOP. And if it's cash, it's used to buy stock once in a while. If it's stock, then it's just stock that goes into the ESOP. We don't do non-leveraged ESOPs very often. Sometimes we'll start with a non-leveraged and move to a leveraged, but by far and away, the biggest type of an ESOP transaction is what we call a leveraged ESOP transaction. And the way that works is we borrow money from a third party, usually a bank, sometimes the seller, sometimes both, but usually a bank. And then that money is then loaned to the ESOP, and the ESOP then pays cash for the stock. So in the ordinary course, and let's just play with an example like this. Let's assume that, a company was worth 10 million and the owner was only selling 30% of their stock to the ESOP for $3 million. In that hypothetical example, what we would typically do is we would borrow that $3 million from the bank. The bank would the company would then loan it to the ESOP. The ESOP would have the $3 million in cash. They would buy the stock from the owner. And that's a leveraged ESOP, because the company owes $3 million to the bank, but the ESOP owes $3 million to the company. And then the question becomes, well, how does that all work? How do we repay that? What does this really mean at the end of the day? So I'm going to jump a few slides forward here and go through kind of how the money flows here on this mechanics of a leveraged ESOP slide. I'll spend a couple minutes here. Bear with me because there's a lot of moving arrows here, and I want to make sure I explain it so you at least have a high level understanding of how the economics works. So let's play with that $3 million example that I just talked about, right? So $10 million company, but we're only selling 30% to the ESOP. So the bank, the lender in this case, in step one, loans that $3 million to the company. In step two, the company then turns around and loans that same $3 million to the ESOP. The ESOP then in step three buys the shares for $3 million. So the shareholder now has $3 million of cash in their pocket. And this is a very, very common transaction. And all three of those steps, by the way, happen on the same day. We do it all on day one. All the wires all go around on day one. So wire from bank to the company, from the company to the ESOP, from the ESOP to the shareholder now gets $3 million. In this transaction, so that's all the day one transaction. Then the question is, well, how do we repay that debt in the future? How do we actually finance that? And by the way, an owner can get $3 million of liquidity out of their business even without selling to an ESOP, right? They can do what we call a dividend recap. They could go to the bank and borrow $3 million and pay that out to the seller in the form of a dividend recap and skip the ESOP completely. But there's some real big tax benefits that come from utilizing the ESOP, as well as some of the other benefits we talked about, right? Like you're actually selling some of your company, so you're starting that ownership transition. You're giving a real benefit to your employees, all the legacy issues we talked about earlier. So another big difference, though, between that dividend recap, where we just pay $3 million out to the seller from a borrowing from a bank versus selling to an ESOP, is that in an ESOP sale, rarely does a bank get what's called a personal guarantee from the seller, where the seller says to them, hey, listen, if the company can't repay the $3 million, I'm on the hook for it. If you're doing a dividend recap, we always see personal guarantee. So really big difference. Why is that? You'll understand in a minute as I go into this a little deeper. But cash flow of ESOP companies to repay that $3 million of debt is much better in an ESOP transaction than it is in a dividend recap. And I'm going to explain some of those tax benefits now. So we finished our transaction. We borrowed $3 million. We bought the shares. Now we're sitting there with the company owing $3 million to the bank, but the ESOP owing $3 million to the company. So how does that work? What we do in step 4 is every year, and let's assume we were paying that $3 million over 3 years. That's not real. We'd probably do it over 5 is typically how we do those financings with the bank, but it's easy math for this lawyer mind of mine to explain how it works. So bear with me on the hypothetical here. So let's say we were repaying $1 million a year. What would happen is the company would actually make a contribution in step 4 to the ESOP every year of $1 million. The ESOP then turns around in step 5 and makes a debt payment back to the company in the form of a debt payment. So that $1 million moves in a circle. Doesn't really cost the company anything because they got it back in the form of a debt payment. But because it was a contribution to a retirement plan, what that does do is it generates for the company a deduction of $1 million. So it doesn't really cost the company a full $1 million to make that debt payment or that contribution to the ESOP. Instead, it only costs, say, $650,000 or $600,000 in my example. Now the company gets the cash back in the form of the debt payment, and they turn around and pay the lender their $1 million. So by having that contribution and debt payment flow through the ESOP, what we've done is we've basically used pre-tax dollars to repay over time that $3 million worth of debt. So you borrow $3 million, but you only have to pay back, the whole $3 million, but because you're getting a tax deduction, your actual cost is really more like, say, $2 million or $2.2 million to borrow that $3 million. So that's why ESOP, one of the reasons why ESOP companies are so much more cash flow positive than financing that type of a transaction in any other way, shape, or form. And it's also why banks tend to not require guarantees or personal guarantees from selling shareholders. The ESOP companies just cash flow a lot better. There was a lot of detail there on a slide. I went through it very quickly. If you have questions, please feel free to raise your hand and I'll try to answer those. Obviously, more than happy for anyone who wanted to get into the weeds on this to have a follow-up conversation and get a little deeper. But I'm only going to talk another 5 minutes or so. So there's only so deep I can go here on this stuff. But I think that kind of highlighted some of the very high level benefits there. Before I stop, I want to touch on just a few very, very small other tax benefits. We've already talked about the one that you basically get to repay your debt with pre-tax dollars. But some of the other There's some case studies in here you can read about. I know these slides are going to be circulated to the whole group when we're done. So you can read about some case studies, some clients in our own neck of the woods here who have done ESOP transactions very successfully. But I want to touch on a couple other tax benefits that may be important to some of you. And one of them is what we call a 1042 transaction. What that basically means is it gives the seller of an ESOP company the ability, if they sell at least 30% to an ESOP, to not pay capital gain tax on the sale of stock. In Pennsylvania, they don't follow that rule, but you still get the benefit at the federal level. Every other state in the country follows the federal rule. So this can be, depending upon your basis in the stock, depending upon the value of your stock, a very material tax benefit. And we highlighted for you here a real life example of a client who thought they could get 18.5 selling to a third party, ended up selling to an ESOP for only 16 million, but because they didn't have to pay tax, they actually put $1 million more cash in their pocket at the end of the day when everything was said and done. So it can be a very, very large tax benefit, but it's just for the seller. So another tax benefit I wanted to touch on very, very briefly here is we already talked about the ability to deduct payments. I want to talk about what it means to be an S corporation and have an ESOP in place. The ESOP is a tax-exempt retirement trust, so it does not have to pay tax on the percentage of the profits that the ESOP owns. In most S corporations, as I'm sure most of you are and most of you know, the shareholder has to pay the tax. But so when you have an ESOP that's a tax-exempt retirement trust that owns an S corporation, what you've effectively created is a tax-free operating company. And we have many of these clients out there that are 100% ESOP-owned S corporations. So think of a company that generates, say, $1 million in profits every year that normally has to pay, say, $320,000 or $400,000 in taxes every year. If that's owned by an ESOP, that's cash that the company can retain because they don't have to distribute it to the shareholder to pay the tax. So it can be a really large material benefit for the company. Again, another reason why banks like they tend to want to loan to ESOP transactions and why we're able to finance these things fairly easily. So a couple other questions that came in that I'll answer, and then I think I'm just going to wrap it up since we're running out of time here. One of them that came in is what happens if a company goes out of business while the loan is in place? If we're talking about the loan that we owe to the bank, then the bank will probably put them in workout. They'll liquidate the assets and recover as much as they possibly can. It's going to be no different than any other company going out of business if they have a debt financing in place with a bank. That said, there was a big study that was done by banks back in the 2008 to 2010 recession. And what banks concluded is that ESOP companies are materially less likely to default in their debt because they just have a lot more cash flow. So if an ESOP company goes bankrupt with the debt outstanding, it's handled just like any other company going into bankruptcy with debt outstanding, but it happens a lot less frequently than non-ESOP companies because of the cash flow benefits. And then last question is, what could prevent a company that wants to start an ESOP from doing so? So if you're already existing and you're thinking about starting an ESOP, there's not a lot of reasons why you can't do it now. What do we look at when we're thinking about sizing of ESOP companies and whether it makes sense to do it? We're looking at, are there enough employees? Usually 20 to 25 employees is a rule of thumb. And there's a slide in here that you can read all of these statistics on your own time, but 20 to 25 employees. Generally a company that has enough cash flow to support the repayment of debt. So we're going to want to look at that carefully to make sure we're not over leveraging or overburdening the company. And generally, it needs to be in an industry where it's not illegal to be owned by an ESOP, which is exceptionally rare. Law firms, for example, are one. Law firms have to be owned by lawyers in every state in the country right now. So a law firm cannot do an ESOP. There are some types of doctors' practices that have to be owned by doctors, although those rules are getting much looser. So generally speaking, we're able to do them even there. So generally speaking, there's very, very limited exceptions from an industry perspective why we can't do an ESOP. So it's really, are you big enough? And do you have the cash flow to support the debt are the things we tend to look at. One last question that came in, I'll see if I can answer that before we wrap it up. Do you need to offer the ESOP ownership to all employees or can you limit who participates? The short answer is because it is a retirement plan and because of the tax benefits that come with being a retirement plan, Congress effectively makes us follow the retirement rules, which means it is designed to be a broad-based plan. And there are ways to limit certain groups of people, but we can only do that if we're doing it in a way that it's non-discriminatory toward the highly compensated employees and doesn't cause a discrimination problem. But as long as we're not causing those problems, there are some ways to do that. Most of our clients choose to do it as broad-based because That's their goal. They're trying to do it that way. So with that, I'm going to go ahead and stop the presentation. Obviously, the slides will be circulated, and I would be happy to answer any follow-up questions you have after you have a chance to look at those slides on your own. Thank you, Kevin.
Yeah, Ed, you did a great job running through that. I know you have to run. Quick question for you. Any stats on retention percentages of ESOPs versus non-ESOPs? Because I think that's one of the big challenges companies have right now.
Yeah, there are actually, and it's a great question. There were a couple statistics in there that I just never got to. So one of them is that first of all, when you look at turnover, like layoffs during a recession, ESOP companies are 4 times, that's 400%, 4 times less likely to lay off employees during a recession. So that's one statistic that goes to that. Another important statistic is that ESOP companies, and this was measured over a 10-year period, ESOP companies have 25% higher job growth than comparable companies in the same industry. So bottom line is it's a good recruiting tool, it's a good retention tool, and the statistics bear that out.
All right, and I know you've got to run 11:30 thing. Thank you very much. A couple of things for members. We're going to put into the chat some additional resources. There is a PA Centers for Employee Ownership, a nonprofit that one of our members was very instrumental in organizing. I think Ed's involved with that as well. So we'll send you a couple links for that. What we're going to do is I'm going to start a thread in the community after this, because I know we have a lot of members that are ESOPs, and Christy, thank you for your comment there. If you want to share, if you are an ESOP, if you want to share your experiences and pros and cons in the community thread, for those of you that want to learn a little bit more from kind of how it's been working for companies, I would encourage everyone to do that. And then, you know, Ed's a great resource. He went very fast. If you would like us to do a more in-depth session, or if you want to take these slides and send it to your CEO or CFO and get back to us, if we get enough people, I'll see if that'll come back and do like an hour long just dedicated to ESOPs, because I really do think there are so many advantages in the companies that I know that are ESOPs, you know, do have that employee engagement. It's worked out very well, and they're very significant tax. But again, he had to jump off, so that's why we went a little quick today. All right, with that, let me turn it over to Amy.